So today we'll start a series of segments about mortgages. All right, we've talked about them in the past, but I want to have some more targeted conversations as it relates to mortgages, home ownership, purchasing of a home, refinancing of a home, reverse mortgages, mortgage guidelines, and much more. Okay, and so we're going to start our mortgage conversation talking about reverse mortgages. Okay, and so why are we starting there? Because someone asked me to discuss it. All right, so before we jump right in to reverse mortgage, I just want to give a general overview or a background of what a mortgage is, how it works, and talk a little bit about some of the other terminology related to mortgages. Okay, all right, so the word mortgage, for those of you who don't know, has Latin and French roots, and it's the root word is mort, which also means death. Okay, so the French Latin root of it literally means the death pledge, or some people say you pay your mortgage until you die. Now, I don't like to think of it in that way, but that is where that word comes from, okay? And so a mortgage is a loan that you take out, and I'm doing real general kind of basic explanations, okay? So a mortgage is a loan that you take out for the purchase of a home. The home is collateral for that loan. You have fixed mortgage terms, meaning the interest rate and the payment are fixed for the life of the loan. And traditionally, when you have a fixed loan, it's a 10-year, 20, 25, 30-year term, okay? Then you can also have an adjustable rate mortgage, or the acronym for that is an ARM. For any of you guys who have heard of that, that's what the ARM stands for, adjustable rate mortgage. And they are typically available in varying terms. The most consistent and main three types of ARMs you have are a 3-year ARM, a 5-year ARM, and a 7-year ARM. And so what does that mean, right? So if you have a 3-year ARM, that means that your rate is fixed for 3 years, okay? And then it'll adjust after those 3 years. So that whole adjustable rate part, that's where the adjustment comes in. So you might ask, well, why would anybody get an ARM? Well, the shorter the term of the ARM, the better the rate. So like a 3-year ARM term, 3-year ARM rate is better than a 7-year ARM rate, okay? And so the shorter the term, the better the rate. And the reason you might get it is maybe you're a military family, you don't live on base, you like living in your own housing, and you know in 2 years you're going to get orders to move somewhere else. So you may want to take advantage of the best rate, so you might get a 3-year ARM, because before it adjusts, you will have sold your house and been out of that mortgage, okay? So that may be the reason why you would get an ARM. We know, though, there was a lot of people in ARM products during the 2008-2009 crisis because it was predatory. So we'll talk about that a little more in another segment, okay? So that is the reason why someone would get into an ARM, because they want to have that lowest rate, because they know that if they don't plan on being in the loan for long, okay? So basically, the bank lends you money, right, going back to the mortgage, to live in a home, and you pay the mortgage back with an agreed upon monthly payment depending on what your rate is, right? And if you don't make your payment, the bank that lends the money to you can take your home back through foreclosure. And so that's what we're talking about, your home being collateral. That's what the home collateral is for. So if you don't make those payments, those agreed upon payments, then they can take it back, because a purchase contract is just that, a contract. You are saying you're going to pay for this loan for the lifetime of that term, and then you get to live in the home and keep the home once you've paid it off, okay? So that's the general info about a mortgage. Now, your mortgage payment is made up of principal and interest, okay? So whatever your payment is, you're paying the principal and the interest on the loan that you've taken out. So a few other requirements for a traditional mortgage are that you pay property taxes and that you purchase homeowners insurance. So the insurance is important because if you have like a catastrophic loss due to like weather or maybe you have a fire and it burns your house down, the insurance allows you to be able to put your house back the way it was prior to the event, okay? It makes you whole, all right? So if you have a weather event and like your roof blows off, then your homeowner's insurance will put your house back together. Again, if the house burns down, that's what the insurance is for. Now, the bank cares about that because they've lent you thousands of dollars for this home, and they want to make sure that the home is still in good quality as well, okay? All right. And then the other thing that you pay, so we talked about principal, interest. We just talked about homeowners insurance. The other thing that you have to also pay is for your taxes. So the reason that you and the bank care about the taxes are because if you get behind on your taxes, like with your county or your city, the county or the city can put a lien on your property and they can foreclose on your home, even if you've been making your mortgage payments on time. Okay, so that's why it's important for you to pay the taxes. So if you've ever been like buying a home or refinancing a home or just listening to like mortgage terminology and you've heard of PITI, well, we just discussed it. P is principal, I is interest, T is taxes, and the other I is insurance. That's what PITI stands for, okay? And when securing a home, that's what you need to pay for when you're gonna have a mortgage. And in some cases, you have to pay PITIHOA. So that's principal, interest, taxes, insurance, and the homeowner association dues. So not all houses or not all homes have homeowner association dues, but if you do, it's important because just like taxes, if you haven't paid your homeowner association dues, that homeowner association can put a lien against your property and you can lose your property due to homeowner association dues, which just seems so crazy to me. But yes, it can happen. And then one thing, we're not going to go into detail, but if you also live in a floodplain, you also have to get flood insurance, okay? All right, so that's how a traditional mortgage works. So now let's just talk a little bit about how your home equity works, okay? So in the past, we've talked about depreciating assets, right? And appreciating assets. So remember, we said that a car is a depreciating asset because the value of the car goes down as soon as you drive it off the lot. So, or at least most cars, okay? The value goes down as soon as you drive it off the lot. And we also talked about appreciating assets, and that's typically your home. So your home typically appreciates. That means the value of your home goes up the longer that you're in the home, okay? So the value of your home is directly related to the equity in the property, all right? So equity in your home is built two ways. One way equity in your home increases is by the value of your home increasing, okay? So you may purchase a home for $100,000, and then after a few years, just because of like market conditions and the area you live in, your home may appreciate. So maybe you bought it for $100,000, but now if you were to sell that home today, it would be worth $120,000. So that means you'd have $20,000 worth of equity in your home, okay? So that's one way your home equity appreciates. And then another way that your equity increases is just by you making your mortgage payments, right? Because as you make your mortgage payments, your mortgage balance goes down. So for instance, you buy that house for that $100,000 and say the value doesn't go anywhere. Say it's still just worth $100,000. But you've been paying on this house now for say 2 or 3 years, and now you've paid it down. So say you paid it down to where you've paid $2,000 towards your mortgage now. Okay, well, because the house is still only worth $100,000, but now you've paid $2,000 down, so now you owe $98,000 on a $100,000 house. So you have $2,000 worth of equity. Okay, so again, even though the value has stayed the same, your equity has increased because you've paid the mortgage down. Okay, now this second example of how to gain equity takes a lot longer. because when you're starting to pay your mortgage at the beginning, most of what you're paying is interest, but you do start to hit some of the principal. So again, just paying your mortgage on time will help you build equity. So two ways: the value of your home going up helps you build equity, and paying your mortgage down also helps you build equity. All right, so we're not going to get into all the mechanics about how a mortgage works, but I just wanted to provide you just a quick overview, because these terms and understanding these terms will help us in our discussion about reverse mortgages, okay? So now let's get into reverse mortgages. So let's compare a traditional mortgage, which we just talked about, to a reverse mortgage. So the reverse mortgage. A reverse mortgage is for homeowners who are 62 years or older. It allows the senior homeowners to tap into the home's equity, which we just talked about, that has been built up, okay? So the understanding here is that maybe they bought their home when they're in their 30s and they're still in the same home, and they now have all of this equity built up. Well, that's what a reverse mortgage does. It allows the senior homeowner, 62 or older, to tap into that equity that's been built up, okay? Now, traditionally on reverse mortgages, there are no monthly mortgage payments, okay? So you're not paying a mortgage payment anymore, but the homeowners are still responsible for the property taxes, the homeowner's insurance, and any maintenance that you do on the home. So let's just talk about that part, right? Let's just compare that. So you have, remember we just talked about on a mortgage, you have to pay the PITIHOA, principal, interest, taxes, insurance, and homeowners association. And if you own a home, you do the repairs or the upkeep on your property, right? So if you're like, my hot water heater went out a few months ago, I had to get a new hot water heater. Or if something happens to my property, I have to pay for that, right? When I pay a traditional mortgage. Well, it's the same thing with a reverse mortgage, okay? So with a traditional, you pay the PITIHOA. And with a traditional mortgage, you typically have to be 18 years old or whatever the age of consent is in your state to sign a legally binding contract. So typically you can buy a house at around age 18 on a traditional mortgage, okay? So when you compare the traditional to the reverse of what we just learned, on the reverse mortgage, you're not paying the principal and interest anymore, okay? You're not paying the principal and interest anymore. But you still have to pay the taxes, the insurance, and the homeowners association fees. And you still have to pay for the repairs and the maintenance that you would have to do, okay? So a reverse mortgage so far is similar to a traditional mortgage. The biggest difference is the age, right? And that you no longer have to pay the principal and interest on a reverse mortgage. All right, so let's keep going. So to qualify for a reverse mortgage, like we said, you have to be 62 years or older. You have to have enough equity built up in your home, and enough is relative to your whole financial need, okay? And so the loan works by the lender now, making payments to the borrower based on the percentage of the equity that has been built up in the home. All right, so let's break that down. In a traditional mortgage, the homeowner makes the principal and interest payment to the bank. In a reverse mortgage, the bank makes the principal and interest payment to the homeowner, okay? And so that's where the term reverse mortgage comes from. Because normally in traditional, the homeowner is the one paying the principal and interest, but in this case, the bank is paying the homeowner the principal and interest. You got it? All right. So with a traditional mortgage, again, you pay the PITIHOA, and you do that until your home is paid off, right? So you got this mortgage, 15-year, 20-year, whatever, ARM, whatever, and you're paying the mortgage until you pay it off, right? That's the end goal in a traditional mortgage, all right? And so when you're making that payment, remember your balance is going down and the equity in your home is going up. Remember my example? $100,000, you paid $2,000 on it. So now you only owe $98,000 on $100,000, so you've grown equity. That's how the traditional mortgage works. And with a traditional mortgage, you can live in the home for as long as you want. You can live in it. You can, maybe buy another home and rent it out or whatever, but you can live in it or not live in it. It's up to you with a traditional mortgage, okay? So whether you live in the house or not, you make the payment. But with a reverse mortgage, the home is repaid when the borrower no longer lives in the home, okay? Traditional mortgage, you can live in it, or you can eventually you can eventually rent it out or what have you. But with a reverse mortgage, on traditional, you pay the mortgage down until it's paid off. With a reverse mortgage, you make the payment on the home once the borrower or borrowers no longer live in the home. Now, why would they no longer live in the home? Well, they might choose to downsize. They might have some health challenges and they can no longer live by themselves. And so now they're living elsewhere, or unfortunately, they might die, right? And so that's when the mortgage payment is due on a reverse mortgage. That's when it's repaid. So, for instance, if you have a husband and wife, okay, and they're both borrowers, if the husband dies, if the wife is a borrower, she gets to still live in the house because that's how the contract is made. However, if you have a husband and wife and only the husband is the borrower, once the borrower dies, the home has to be repaid. Okay? We got that part? Okay? And with a reverse mortgage, remember, instead of like a traditional, when you're paying the mortgage balance, you're paying the balance down and the equity is going up. With a reverse mortgage, the bank is paying you the principal and interest and your equity is actually going down. Okay? Because how they're paying you is with the equity built up in your home. So instead of your equity going up in traditional, it goes down. And so with reverse mortgages, borrowers usually use the monthly payments that are being given to them to pay for their living expenses. So that you might be like, well, why would anybody get a reverse mortgage? Well, the way it's sold to most people is that, you're older, maybe you're on a fixed income, and maybe you're having a hard time paying for your expenses. And so now the bank is paying you, and so you can use that money to supplement your expenses, okay? So you have borrowed money, you have the interest and the fees, and you have a rising loan balance on a reverse mortgage. Let me go over really quickly some of the pros that are listed as for reverse mortgage, okay? And then we're going to stop right here, and then we'll continue our conversation about reverse mortgages next week, and we'll give you some more of the details, all right? So some of the pros, because again, why would anybody do this, right? So these are some of the pros that are out there in the mortgage world. So you can continue to live in your home and retain the title to your home as long as you continue to pay the property insurance and maintenance on the home. Well, why would anybody want to do that, right? Well, you have some times where people are like, I've lived here 30 years. I don't want to downsize. I don't want to sell my house. This is my house. I want to still live in it. But maybe they can no longer afford all of the payments that are go along with it. So the reverse mortgage is a way for them to stay in the house, to keep the title to the house, and be able to stay there and have the proceeds be paid to them, okay? That's one pro. Again, with another pro is you generally receive the proceeds of the loan. So as the bank is paying you those monthly fees, that's tax-free money, okay? And so that's also a benefit. But again, each state is a little bit different, so you need to check your state, do your own research to see if it would truly be tax-free for you. And then because for most, you don't take any monthly mortgage payments during the course of the loan. So, you don't have to pay any mortgage payments anymore during the course of the loan, because remember, they're paying you, all right? And then a reverse mortgage, also the benefit of this is, again, you are having your expenses supplemented, all right? So those are some of the pros of it. What I'm going to say about it is, because there are some people, and this is really a good fit. What I try to do here each week is give you the information, but what my hope is that you will do your own research and you make a decision for yourself, okay? What I can say about this so far is I can see how this could be predatory. Because if you have people coming, telling an elderly person, hey, let's go ahead and do a reverse mortgage for you. It'll pay you. You don't have to worry about it. That could be predatory, right? Because again, once that person dies or whatever, if the family's not fully informed, the family no longer keeps the house, all of that, it could get pretty sticky. And we'll get into that some more next week. And what my suggestion would be is if you're having problems meeting your expenses, then you need to find a way to lower your expenses, okay? And I know that's a hard conversation to have with someone who's lived in a house for 30 years, but maybe as a an adult child of parents, maybe that's a come to Jesus kind of moment, like mom, dad, you cannot afford this anymore, or you need to help your parents understand how they can reduce their expenses. So that would be the tips that I would give. But again, that's me looking, from the outside in my own situation. I don't know what your situation is, okay? But there has been a link to the CFPB. That's the Consumer Protection Bureau that gives all consumers information about like credit cards and mortgages and all of that. And so we put a link in the comments there. If the reverse mortgage is something that you're interested in learning more about, please go there, because it's going to give you information that's going to be from the perspective of the consumer, and not just from the perspective of the of companies trying to sell you a reverse mortgage. Okay. All right, so next week we will conclude our conversation about reverse mortgages, all right? And then like I said, in the weeks to come, we're going to be talking about all aspects of mortgages, home ownership, refinances, all kinds of stuff, okay? We're going to go and talk about all of those things, saving for a home, all of those things, all right? So